Hi, everyone. Today we are covering reference-based pricing as a part of our larger series covering benefit funding models. I'm Bukola Ishola Broome. My pronouns are she, her, hers, and I'm a client manager here at Nava Benefits. I have been in the HR and the insurance industry for nearly 15 years, and my focus is on consulting and implementing innovative benefit strategies for employers. Today, I'm joined by Marcel Ocampo, Nava's partner and market director. Marcel, could you kindly tell me a little bit about your role and what led you here?
Fantastic. Well, thank you so much for allowing me this opportunity to have a discussion with the attendees here today. My name is Marcel. I've been with the organization since December 2020. Total industry experience just under 25 years. So it's been just fun just seeing how the industry has changed over the past 2 decades. So my role is to grow the California region, but not just that, but also provide strategic input on behalf of some of our clients. And so one of which is we're going to be talking about here today. It's going to be about reference-based pricing. I do have expertise there. And so whenever there are folks that have questions, whether clients or colleagues internally, I'm usually the subject matter expert that people lean to.
Wonderful. So thank you so much, Marcel, for that brief intro. Let's just dig right in. What is reference-based pricing and how does it work?
Sure. So really, we're going to go unpack those 3 words, right? It's the reference, right, based and pricing. So what does that mean? So we are referencing really 2 different metrics, right? One of which is the actual cost of care that the hospitals report to CMS, which is Centers for Medicare and Medicaid Services. I believe that's what CMS stands for. Don't punish me if I'm wrong. So that's one reference that we're using. The second reference is what Medicare pays. Okay, so you might have heard this in the industry as Medicare Plus or Cost Plus or reference-based pricing. It's all synonymous. So on this slide, you have your spectrum of options. There's no right or wrong answer based on where you are at currently. And here at Nava, we are absolutely agnostic in as far as which recommendation might make the most sense for each client, right? Because each client is as unique as one's fingerprint. So any one of these particular options, as part of our overarching masterclass series, we have deep expertise as far as whether you're captive or reference-based pricing. We have clients we have placed in any of those buckets. Now, with respect to reference-based pricing, it's not necessarily a funding arrangement in of itself, okay? It's really more of a mechanism by way you reimburse healthcare providers. So what reference-based pricing is, again, going back to what we're referencing, right? Either the cost of actual care that's been sent over to a CMS or what Medicare is paying, is we're taking a bottom-up approach, which is what this slide is showing, okay? Versus a top-down approach, which is what your traditional self-insuring reimbursement looks like, okay? So if you have not yet watched our self-insuring masterclass, this is a good time to pause or even revisit that before we unpack this, because we're about to go on one heck of a ride as far as what reference-based pricing is. So in this example, there is a charge master price. Now, what exactly is a charge master? Think of a hospital or healthcare provider. They have, think of it as like a deep book or like a menu, okay, of all these other different procedures that they render, okay, whether it's a NICU claim or a premature baby to a broken arm to even just an office visit. So charge master price is what they would charge, if you're a retail, patient, right? You don't have any sort of insurance. This is what's going to cost. But it's pretty, fictitious if you're asking me about that, right? Because if you were to ask them, a lot of folks in healthcare, how they came out with charge master price, most of them probably couldn't tell you what that is. So your traditional insurance plan, okay, takes a top-down approach. So in this example, there's a $5,000 claim. Your BUCA or Blues, United, Cigna, or Aetna. It's an acronym, right? BUCA, and we're going to refer to that every now and then. So your BUCA typically will have a discount of, let's say, 50 or so % for this particular claim. So what they're going to charge to the employer here, if you're when you're self-insured, is going to be $2,500. So now your plan assets, they're drawing that from your bank account. So that's the traditional method of renting a network. So reference-based pricing, we are eliminating the network for facility charges typically. Okay, you could do this also for physicians and primary office visits, but typically we're just going to focus for the here and now on facility charges, because the majority of the spend is going to be hospital visits, outpatients, and so forth. So now what RBP aims to pay is going to be from a bottom-up approach. So here, what's the actual cost? $250 is an example here, okay? And Medicare that's being reported, right, what they pay to this facility is $280. So now the reimbursement method of RBP will dictate that we are going to go pay the greater of two metrics, either 112% or 12% above the cost of care, okay, or the higher or Medicare plus 20% or 120% of Medicare. So whichever is higher is what you would be paying to the healthcare provider. So hopefully that answered the question. I know we unpacked that very deep and very quickly as far as what RBP is all about.
Yeah, no, thank you so much, Marcel. That was such a great, thorough explanation about what RBP is. But my question for you is, what are the pros of RBP? I mean, besides the cost, there has to be other pros as well.
Sure. The biggest pro you'll get in reference-based pricing is massive savings, typically. I've seen it where we've been able to save clients about $3,100 per employee per year. Pretty substantial, right? So if you have 100 employees, well, 100 times $3,100, it goes up pretty fast. Another pro with regards to reference-based pricing is you're dictating your reimbursement method. Okay, so again, it's a reimbursement method. It's one of the tools in your toolbox. There's also other reimbursement methods, such as renting a network. Okay, another reimbursement method might be having a direct contract. Okay, with a hospital or local healthcare provider. Bundle payments is another option. So RBP is just one tool in your toolbox to be able to reimburse at a lower unit cost than you would from your traditional renting of your network. So again, to be able to entertain any of these reimbursement methods, you have to, step number one is you have to self-insure, unbundled self-insured. Okay, so typically means you are not going to go with your BUCAs, okay, with your traditional carriers to self-insure. So you could absolutely rent their network, but to have a third-party administrator to be able to adjudicate those claims, to assist with the reimbursement methods, those are going to be the biggest drivers to be able to get folks on the plan and to be able to assist the HR professional on a day-to-day basis. So I'll also call out one other thing is you can also still be on a captive as well, okay, and do reference-based pricing. Wow. So again, the whole part of a captive, it's an alternative funding method versus a reimbursement method.
Right. Wow, wonderful. So thank you so much for laying out a lot of the pros. However, I'm kind of curious, are there any drawbacks that any employers should consider before thinking about reference-based pricing?
Absolutely. And that is a great question. That is the thing that we absolutely must caveat the heck out of RBP. Okay. So there is a lot of pros with self-insuring, with, just with self-insuring in general. RBP, yes, the cost is the biggest driver. The biggest cons is that it's there's opportunity for the healthcare provider to say, hey, we're not getting as much back as we are not getting reimbursed as much as your BUCAs, okay? And they might come back and say, hey, we normally would, going back to the prior example, we normally get $2,500 here. How come we're getting just under $400 for the exact same claim, okay? And so what they can do is they can balance bill your employee, or they can come back to the employer and ask for more money. There could be litigation, there could be credit impairment, there could be a ton of other things that the healthcare provider can do to see they can get more money back from for all parties involved. Another key possible con is they can say that, hey, Joe Smith, an employee of Acme Corp that's on a reference-based pricing plan, we will not see any employees that is with Acme Corp or specifically with this employee. Okay, so so that is probably the biggest cons. So now probably the follow-on question is, well, what can you do about it? Okay, because that's what I would ask, right? I would ask my advisor this question. It's like, oh, hey, we love the savings. There's other people in the Midwest, other parts of the country, down south where RBP is quite common. Okay, so how are they able to do this on a multi-year basis? So really, some of the ideas that come up that you can do is number one is you could create safe havens. Okay, meaning that you can have like for instance, there's a provider out there like Imagine 360, okay, that has Baylor as a safe harbor, right? So there's if you have a provider in Texas that is balanced billing or doesn't want to see the provider outright, there's an avenue to have that patient go see a Baylor provider. So that's one step, okay? Additionally, to prevent the credit impairment, you would hire a third-party administrator, okay, like an Imagine 360, AMPS, 6 Degrees. There's a ton more players now than when I first started doing RBP, okay, because it's been working. Even UHC, okay, one of the Bukas is now in the RBP game, okay, so Cigna as well. So it works, okay, but you just got to make sure you do some sort of gut check with regards to risk and reward, what you're willing to do. Typically, the ideal client profile that makes the most sense for RBP are typically industries where they have razor thin margins, okay, or even not necessarily a razor thin, but even banking. We've seen financial services adopt RBP because the dollar saved is another dollar that they can lend out and absolutely increase their margins, right? So but typically what I've seen is I've seen manufacturing, trucking, a lot of nonprofit, even healthcare accounts, believe it or not, right? You have healthcare accounts saying, well, we want our employees to only see, our doctors. If they go see the competing provider, we're going to RBP them, okay? So yes, absolutely, it does work, okay? So, but yeah, so when you hire any one of these third-party providers, they can prevent the whole credit impairment. They can fish a bill that's been sitting in collections, and they'll protect your employee and also the employer for the life of the claim. Okay, which means that let's say that, hey, after 2 years we hate RBP, but we have an outstanding claim here that's still going through the process. They are on the hook until that thing closes out. So even though you terminate RBP, they're going to keep fighting that fight. So what's been telling, just some sort of case history here, it's been battle tested. For instance, the state Supreme Court of Georgia, where a provider said that, hey, we want our money, we're going to take this employer to court. And so the state Supreme Court of Georgia said that, hey, you know what, you're not able to substantiate a 10,000% markup on this procedure. Okay. So feel free to Google that and, do your homework and get back at me.
Will do. So I really appreciate you taking a moment to really dive into what that member experience would be like. Sometimes people live in a community where it's really remote, or perhaps there's only one hospital. So I really do appreciate you talking about how the TPA will sit there and help that member get those claims adjudicated and to hopefully avoid any type of potential litigation that the employer or the employee could experience. But I'm kind of curious. What is the HR experience in terms of the lift and what they're going to potentially go through? Because that's certainly going to be something that a lot of you guys who are on this meeting right now are kind of curious about. What is this going to mean for me? So Marcel, do you mind expanding on that?
Absolutely. Great question. In fact, if you didn't ask this question, eyes wide open, then you should really be concerned. So, what you can come to expect in your role in HR, okay, is now that you are going to be the person with the finger on the pulse, right? You're going to be the person that everybody's going to lean to when something goes wrong, like a balance bill. So Is there more work? Definitely. Okay. I'm not going to sugarcoat it. In fact, there's even more work to self-insure. Okay. So if you're fully insured, there's going to be more work with self-insuring. But the thought of it is if you're saving enough money, you're providing some sort of ROI to your job function. Okay. Additionally, you're going to get a lot more than you bargained for with regards to insight and claims. In fact, it might make you angry, right? Like you're going to see a NICU claim that comes in for $1 million, where I've seen this actually in my prior life, where I've seen $1 million claim, except it's not just one baby, it's triplets. So now it's a $2.9 million claim, but let's round up to 3 million. At this point, we're dealing with big numbers, $3 million, that's going to hit the stop loss anyway. So, so what had happened is they looked at, the CMS and see, how much it will, typically what was going to cost. And they RBP'd the whole thing. Okay. And the healthcare provider cashed the check, no questions asked, at just under $200,000. Now, would that make you upset? Right. So, so you have cases like that, right? Now you just saved how much money on behalf of the employer, right? Typically what I've seen HR do, okay, is like they say, now we would like to, it takes more work. We would like to hire more HR folks to be able to assist here, because look at the savings that we've been able to produce with respect to the benefits program. So yes, there's absolutely a lot more work, right? You have to deal with not just the quarterly business reviews, okay, on just any sort of self-insuring, okay? Your Fortune 500 does this all the time, by the way. Your Amazon, Google's, Facebook's, okay, Caterpillar, who's on our Benefits Advisory Council. So if you talk to Todd Bisping, absolutely, this is like, they're always looking at the claims, but they're providing so much value to the organization that they're willing to invest in the benefits department. So hopefully that made sense. I'm not sure if I might have missed anything, Bukola, so feel free to steer me back on path if I missed that question.
No, that made absolute sense. And frankly, I believe that most HR folks who are on this call right now might be very, very interested in maybe taking another step and learning a little bit more. So what would be your steps here to get this implemented if this is something that an employer is interested in?
Absolutely. So number one, if you're not self-insured, you have to self-insure. I don't know if I would go from fully insured, okay, to reference-based pricing, a drop of hat. Having said that, my very first reference-based pricing client was for a group for, I think, just around 1,500 employees at the time. Went from BUCA to RBP with a 6-week, decision to implementation. It's doable. Do I recommend it? No. Okay, so let's not do that. So implementation, okay, you have to self-insure first, okay? And so you have to look at feasibility studies, you got to get all the stakeholders on board, which is also a key first step. You need to get the C-suite involved, okay? And a couple other champions that might be a supervisor of like key populations, okay? Get them on board, have them pull in the same direction. Hey guys, this is what we're doing. There might be some member abrasion. But in consideration, I'm all about a shared risk, shared reward. In consideration of this additional lift, potential abrasion, including HR, right? Because now you're seeing the claims and your third-party administrator or TPA is going to come back to you and say, hey, do you want to pay this claim? Do you not want to pay this claim? Do you want to fight it? Or do you want to negotiate off this 120% of Medicare to maybe 140% of Medicare just to shut them up and we can go on our way? So that's an additional lift for HR, right? But in consideration of the additional lift, right? Shared risk, shared reward. Okay, let's talk about the reward, okay? Everybody's going to do X more, okay, of what's being expected. What we can come to expect as a reward is better cost share, cheaper benefits, potential pay raises for HR. I'm totally pandering to you, HR. Or better, stronger financial statements, right? If you're a CFO. This is why a lot of PE-backed firms look to RBP to be able to shore up their financials. So that's a key first step, is getting everybody on board. Second step is you have to find an advisor that knows what they're doing. They've been doing this for a long time. Okay, if they never have ever done RBP or Cost Plus or Medicare Plus, then make sure you get references and also talk to even carrier reps. That like 6 Degrees or AMPS or whoever. Okay, we've done business with a lot of them, so completely agnostic too, by the way. And so ask them what their thoughts are. Get clients' references from those advisors. Okay, so that's step number 2. Step number 3, okay, is you got to do the feasibility study. Okay, so this is what it looks like if we're going to go RBP, and have a no BS discussion of like potential blowbacks. Okay, typically any one of these TPAs will tell you what kind of noise is what they would call it, what kind of noise that you would get back from some of these healthcare providers. Okay, so they might say, hey, this particular market, like for instance, DFW, Dallas Fort Worth, there's a higher incidences of noise because that's kind of ground zero for what RBP is. So a lot of these healthcare providers are already onto the game, but yet there's still employers that still do RBP, right? There's ways around that. So that's another step. Another step is determining what's your appetite for risk versus reward. And if you are a little bit more conservative and you still want to do RBP, you could do a dual option. You could have like an RBP plan here. And I'm out here in California where we designed these kind of plans where you have RBP, self-insured, right? Reference-based pricing, 1, okay. Second carrier, fully insured Kaiser. You could do that, absolutely, okay. But make sure you know the ramification by doing a dual option, right? So there's this thing called death spiral. If you don't know about that, talk to your advisor or talk to us. But you got to make sure you put safeguards with regards to these plan designs. So, and finally is making sure if you make a decision, say, hey, we're going to absolutely do RBP, okay, then have a very long runway for member education. You don't do this thing if you have a one effective date and you're doing this in November. No, you're starting this thing off ideally late September, early October, and saying, hey guys, this is what we're doing for our benefits, and then you start to incent people on these learning sessions, okay? And then post-enrollment, then you do a sweep up. It's like, hey guys, at the end of January, assuming you have a January 1st effective date, is we're gonna have a lunch and learn. We're gonna have a fireside chat with our advisor or with our TPA to answer any questions you may have so far. And then do another one again the following month, just to make sure that, because now you're getting claims coming in, we wanna make sure that people are aware of this because they talk to each other, right? So you want to make sure you get out ahead of that. And also having a creative campaign to make sure that people are absolutely digesting all this information. So it is a lot to unpack. Okay, we know it's a lot of work, but this is where like an advisor worth their salt is going to be able to say, hey, we're going to do this. Here's our project management, how it's going to look like. Here's our timetables. Most of that we're going to shoulder. This is what we can come to expect from you as the HR professional and your CFO or finance department.
Wow. Thank you so much, Marcel. I'm just channeling my HR hat, and I probably agree with a lot of the other people on this call that a long runway is super helpful. But in addition to that, continuous employee education on how to actually navigate RBP. And that actually brings us to the end of our session. Thank you so much, everybody, for joining this call. Thank you so much, Marcel. Every time I chat with you, I always learn something new. That everybody else on this call has found this session completely useful. And if you are curious about funding arrangements, please feel free to reach out to Marcel or myself, and we will more than happily get back to you with any answers that you may have or answers to questions that you may have. Thank you so much, and I hope you guys have a great rest of your day.